Let's break down interest rates, what they are, how they're decided, and why they matter when it comes to buying a home someday. An interest rate is basically the cost of borrowing money. When you take out a loan, like a mortgage, the interest rate is what the bank charges you for using their money. But here's the big question: who decides these rates? Well, your lender sets the final number, but a lot of it depends on something bigger: the Federal Reserve, or the Fed. The Fed doesn't set mortgage rates directly, but it does control something called the federal funds rate. That's the rate banks charge each other to borrow money. When the Fed raises that rate, it makes borrowing more expensive everywhere, including for home loans. Right now, the economy is going through some changes that make things tricky for future homebuyers. Inflation has been pushing mortgage rates higher over the past year. To try and bring inflation down, the Fed has raised rates several times. This is called tightening monetary policy, and it means borrowing money for things like houses or cars costs more. But it's not just the Fed. Other things like job growth, how much people are spending, and how the economy's doing overall also affect interest rates. So yeah, it's a lot, but understanding how it all works now can help you make smarter choices later, especially when it comes to big financial moves like buying a home.